Well, hi there. My name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for October 2019. Well, all things considered, North American markets managed to deliver modest returns for the month of September, closing out a positive third quarter. The launch of an official impeachment inquiry over U.S. President Trump's alleged abuse of power in September is proving to be an interesting distraction. However, we do not believe that this will have a material impact on the stock markets. Instead, we remain focused on three familiar themes: the U.S.-China trade war, slowing global growth, and central bank interventions and more accommodative monetary policies. Driven by daily sentiment on these issues, investors continue to ride a market roller coaster with no real resolution in sight. The fact that further distractions, such as the Trump impeachment inquiry or the Saudi oil refinery attack, result in so little effect only reinforces our expectation that this market dynamic is now likely to drag on into 2020. The U.S.-China trade dispute continues to hold back business investment, which does impact economic growth, and to compound these risks, global trade flows have been slowing, prompting central banks in both Europe and China to intervene with more monetary policy stimulus. While Canada and the U.S. are seeing a slowdown in manufacturing, the services sector is picking up the slack in both countries. In the U.S., hours worked, along with non-farm payrolls, have been increasing and wage growth has been healthy. Full-time employment is also strong in the 25 to 54 age group, and this demographic is important to overall spending on durable goods. In Canada, unemployment is near all-time lows and wages are also increasing. Given high household debt loads and an already accommodative monetary policy, the Bank of Canada has been less inclined to provide additional stimulus from fiscal policy and rate cuts. Furthermore, if upcoming elections result in a minority government, implementation of new stimulus may be challenging. This makes the outlook for growth in Canada still positive, but less optimistic. Overall, the shift towards a more accommodative monetary policy by central banks around the world has investors discounting many of the headwinds we've addressed. While interest rate cuts and quantitative easing have proven to be effective tools in stimulating growth in the past, it's yet to be seen whether these tools remain sufficient to stimulate developed economies given the warning signals of an impending global recession. Our conservative income-focused portfolios continue to outpace their benchmarks in the third quarter of this year. The overall strategy has been to rotate out of assets and sectors that are trading at heightened multiples and into assets and sectors that are trading at depressed values compared to their historical ranges. We also continue to integrate a variety of option strategies to help enhance cash flow and manage risk. Our growth-oriented portfolios are also outpacing their benchmark both in the quarter and year to date. We continue to hold a higher allocation to cash with a preference for tactical and active trading. Having a higher allocation to value stocks resulted in a sizable jump in performance in September as investors moved out of momentum stocks and into value. That said, given our views, we continue to remain defensive. While we may have missed some of the equity upside in the first half of the year, our defensiveness is paying off as we continue to gain ground while managing risk in uncertain, range-bound financial markets. When analyzing the underlying economic fundamentals, the likelihood for a global growth slowdown or even a recession and the associated risks to the stock market are clear. This outlook continues to support our active, tactical, and defensive management approach into the fourth quarter. That said, we have learned never to underestimate the power of certain factors, such as an increase in accommodative central banking monetary policy, to flip the financial market switch back to risk on. If this occurs, we will adjust our positioning accordingly.